After the volatility spikes this summer, it's time to reassess risks. The surge in stock market volatility in August is a reminder that markets may be more fragile and nervous than they appear. During this episode, the VIX index, which measures the implied volatility of the S&P 500 index, went above the 65 level, which represents the third highest peak in its history. Before that, the two most severe peaks were the collapse of Lehman Brothers in October 2008 and the COVID pandemic outbreak in March 2020. I'm sure that you will agree that this early August had nothing in common with those two historic moments. So what happened? When we see such an extreme move, there is no single factor behind it. The first phase of the crisis started by worse than expected US employment data release. Fears of a more significant economic slowdown in the US were suddenly back. As a result, equity markets went down and the VIX index rose, also nothing dramatic until then. Almost at the same time, the Bank of Japan announced a 15 basis point rate hike, more than the market expected. And both news combined triggered one of the most intense carry trade unwinding in history. As we can see on the chart, the Nikkei index literally plunged in 4 business days while the yen jumped. The S&P 500 also corrected significantly, but the VIX index spiked far more in comparison to the spot price. The market is far more nervous than at the beginning of the year. It is clear that developed market central banks, at the exception of Japan, will cut rates to face a sharper economic slowdown, but the market's depth has been reduced. Nvidia can continue its exponential rise by trying to meet the demand from gigantic capex deployed by the US tech giants, but the probability of disappointing investors is also higher now. India is seeing its promising growth confirmed, but it's also reasonable to think that the valuation of Indian stocks has become excessive. Geopolitical risk may be on the downside in the near future, but nothing is certain, and the risk premium does not seem particularly high. This highlights the way events can unfold in certain market configurations. Technical factors can drive markets to the detriment of fundamentals. This is why risk management is essential when it comes to investing. This end of summer period seems to be a good time to ask ourselves what kind of risk we want in our portfolios and to favor a diversified approach in terms of asset allocation.